Every single U.S. president since 1985 has launched military operations in the Middle East. George H.W. Bush, Bill Clinton, George W. Bush, Barack Obama, Donald Trump, first term, and now Donald Trump, second term. Iran, every single time. And every single time, so without a single exception in 40 years, the Federal Reserve has responded to those military campaigns by cutting interest rates, expanding the money supply, or both. Every time. 1990 Gulf War, Fed cut rates. September 11, 2001, Fed held an emergency meeting and cut 50 basis points within days. Iraq War 2003, Fed maintained low rates throughout. Afghanistan, quantitative easing followed. Syria, liquidity operations. And now, February 28, 2026, the United States and Israel have struck Iran. And Arthur Hayes, the co-founder of BitMEX and one of the most analytically rigorous voices in the crypto space, published an essay this morning connecting those 40 years of dots in a way that changes how you think about what just happened to Bitcoin this weekend. Not in a speculative, hype-driven way, in a historically documented Federal Reserve minutes-quoting, pattern-based way. And by the end of this video, you are going to understand that framework completely, and you are going to see 3 other simultaneous developments happening right now that, when combined with Hayes' thesis, create one of the most complex and consequential market setups Bitcoin has faced in its entire 17-year history. Every number in this video is verified. Every quote is sourced. Let's go. Let me start with the data that most people are completely missing right now, because the headline narrative around Bitcoin is war or crash, and the data says something fundamentally more nuanced. November 2025 saw $3.48 billion in ETF outflows. December brought $1.09 billion. January 2026 brought $1.61 billion. And February, the month that included a war, a PPI shock, a 128 billion single-hour market cap wipeout, and 5 consecutive months of losses, closed at just 206.52 million in net outflows, a 94% reduction from November's peak. Let me put that number in context. In November, institutions were pulling approximately $2 billion per month from Bitcoin ETFs on a run rate basis. In February, despite everything, that monthly outflow collapsed to $206 million. That is not a headline. That is a structural signal. It means the institutional selling that drove Bitcoin from $126,000 all the way to $63,000 is mechanically exhausting itself. The wave is breaking, and it is breaking at the exact moment that Arthur Hayes is publishing his most important essay of 2026. On February 5th, the 30-day rolling net position change for long-term holders stood at negative 243,737 Bitcoin. By March 1st, that figure had fallen to just negative 31,967 Bitcoin, an 87% reduction. Long-term holders, the wallets that have held Bitcoin for 365 days or more, are the most important cohort in the entire Bitcoin ecosystem. They are the people with the strongest conviction and the longest time horizons. They are not traders. They are not hedge funds running basis trades. They are the bedrock holders. And their selling, which peaked in early February at a level not seen since the 2022 bear market, has collapsed by 87% in less than 4 weeks. When long-term holder selling dries up, Bitcoin historically stabilizes and then begins to recover. That's not an opinion. That's what the on-chain data shows cycle after cycle after cycle. Bitcoin miners who sell BTC to cover operational costs saw peak capitulation around February 8th when net selling hit negative 4,718 Bitcoin. By March 1st, that had eased to negative 837 Bitcoin, a sharp decline that suggests the worst of miner capitulation may be behind us. 3 separate seller cohorts, ETF redemption sellers, long-term holders, and miners, all hitting peak selling simultaneously in February, and all 3 showing dramatic reduction by March 1st. That is not coincidence. That is the anatomy of a market bottom. Not a guaranteed bottom, not a confirmed bottom, the anatomy of one, the structure that has preceded recoveries in Bitcoin's history. Now let me walk you through Arthur Hayes' thesis, because this is the most intellectually significant piece of Bitcoin analysis published today, and you deserve to understand it in full. BitMEX co-founder Arthur Hayes published a new essay on March 2nd arguing that prolonged U.S. military engagement with Iran would increase the likelihood of Federal Reserve rate cuts and money printing, ultimately driving Bitcoin higher. His thesis rests on a 4-decade pattern. Every major U.S. military campaign in the Middle East has been followed by Fed easing. In iOS warfare, Hayes presented a historical analysis linking U.S. military operations in the Middle East to subsequent monetary easing by the Fed. He noted that every U.S. president since 1985 has launched missile strikes or full-scale wars against Middle Eastern countries, and that the Fed consistently lowered interest rates in the aftermath. Let me walk you through the specific historical precedents Hayes cited, because the Federal Reserve's own minutes prove this pattern exists. From the August 21st, 1990 FOMC discussion on the Gulf War, Hayes quotes, "The heightened uncertainties and the prospectively less satisfactory performance of the economy stemming from events in the Middle East had greatly complicated the formulation of an effective monetary policy. In the opinion of several members, events appeared likely to unfold in a direction that would require an easing of policy at some point to counter weakening tendencies in the economy. The Fed cut rates in November and December of 1990. Bitcoin did not exist then, but the pattern was established. Hayes also cited the Federal Reserve's emergency meeting following the September 11, 2001 attacks, when then-Chair Alan Greenspan reduced rates by 50 basis points, referencing a heightened degree of fear and uncertainty affecting asset prices. Hayes said, U.S. military intervention in the Middle East has ultimately resulted in greater money supply, adding that the moment the Fed cuts rates or provides liquidity to help the government achieve its objectives is an opportunity to buy Bitcoin and high-quality altcoins. In Hayes' own words, the longer Trump engages in the extremely costly activity of Iranian nation-building, the higher the likelihood the Fed lowers the price and increases the quantity of money to support Pax Americana's latest bout of Middle Eastern adventurism. Now here's the critical nuance, and Hayes was explicit about this. Despite his bullish long-term outlook, Hayes advised caution in the near term. He recommended investors wait for the Fed to actually cut rates or begin printing money before adding exposure to Bitcoin and select altcoins. We do not know how long Trump will remain interested in spending billions, if not trillions, of dollars reshaping Iran's politics to his liking, Hayes wrote. That is an important distinction. Hayes is not saying buy Bitcoin right now because of the war. He is saying understand the historical pattern, watch for the Fed's response to emerge, and when the Fed signals easing, that is the moment. The war is the setup. The Fed response is the trigger, and the trigger has not fired yet. Now let me tell you about something that happened simultaneously with Hayes' essay being published. And this is the development that I think is the most underappreciated story of March 2nd, 2026. Strategy acquired the Bitcoin between February 23 and March 1st, 2026, spending approximately $204.1 million at an average price of $67,700 per BTC, inclusive of fees and expenses. Following the latest acquisition, Strategy now holds 737 Bitcoin as of March 1st, 2026. Strategy has acquired 3,015 BTC for approximately $204.1 million at approximately $67,700 per Bitcoin. As of March 1st, 2026, we hodl 737 BTC acquired for approximately $54.77 billion at approximately $75,985 per Bitcoin. The 3,015 BTC acquisition marks Strategy's 101st Bitcoin purchase, coming shortly after the company publicly highlighted its 100th buy as a major milestone. The filing reinforces that Strategy continues to execute its long-term Bitcoin accumulation strategy, using equity market access to steadily grow its position rather than time short-term price moves. Think about what just happened. In the same week that Bitcoin fell to $63,000 because of a war, a $128 billion market cap wipeout, and a hot PPI print, Michael Saylor's company bought 3,015 Bitcoin for $204 million. Strategy's stock is down about 50% over the past year and 18% year-to-date, tracking Bitcoin's recent decline. The latest deal marks the company's 10th straight weekly Bitcoin purchase, 10 consecutive weekly Bitcoin purchases, through a 48% drawdown, through a hot PPI shock, through a war, 10 in a row. Strategy's holdings now represent just over 3.4% of Bitcoin's 21 million maximum supply. One company, 3.4% of all Bitcoin that will ever exist. Stop. At current market prices, the company's Bitcoin holdings are valued at roughly $47 to $47.5 billion. This places Strategy at an estimated unrealized loss of between $7 billion and $9 billion, depending on price movements. $7 to $9 billion in unrealized losses, and they bought again this week at $67,700 per coin. That is not desperation, that is conviction. The kind of conviction that comes from a multi-year, fully documented thesis that has been stress-tested by every possible adverse scenario the market can produce, and has not broken. In the fourth quarter of 2025, Strategy reported a $12.4 billion net loss, driven largely by unrealized crypto losses, $12.4 billion net loss in a single quarter, and they bought again. Michael Saylor posted the purchase on X. The man does not waver. You do not have to agree with his strategy. But you cannot ignore the behavioral signal it sends to the market. Now let me give you the full picture of what Bitcoin's market structure looks like right now, because I want you to see everything simultaneously, not in isolation. The sentiment in the Bitcoin markets is currently bearish, and the fear and greed index is reading extreme fear. The most important support levels to watch are 64,293, 61,607, and 59,964, while 68,622, 72,65, and 72,951 are the key resistance levels. 3 indicators are currently signaling a bullish prediction for Bitcoin, while 26 indicators are showing a bearish forecast, with 90% of indicators favoring a negative prediction. As of March 1st, the 30-day rolling correlation between Bitcoin and the S&P 500 stands at 0.55, up from around 0.50 in October 2025. This means the Bitcoin price continues to move largely in step with stocks, undermining its appeal as a hedge against traditional market risk. Kevin Crowther, founder of KC Private Wealth, emphasized this dynamic. Bitcoin's high correlation to software stocks weakens its case as a hedge asset in times of uncertainty. And so as Trump continues to elevate economic uncertainty, continued BTC weakness should be expected, Crowther said. This is the bear case in plain language, and I want you to hold it seriously, because the bull narrative, as compelling as Hayes' historical thesis is, has a real counter-argument. Bitcoin is not behaving like digital gold. It is behaving like a leveraged tech stock. When the Nasdaq falls, Bitcoin falls. When the Nasdaq recovers, Bitcoin recovers with amplified volatility. In an environment where U.S. military action in Iran is creating genuine global risk-off sentiment, where oil prices are under pressure, where equity markets are nervous, where the DXY is at multi-year lows, Bitcoin's correlation to equities means it remains vulnerable to further macro shocks regardless of what the on-chain data says about selling exhaustion. Prediction markets show bearish consensus at historic highs, with over 60% of polymarket participants expecting BTC to fall below $50,000 at some point in 2026. Though sentiment extremes of this kind have historically been poor timing tools. Extreme fear readings of this magnitude, single-digit fear and greed scores, prediction markets pricing in near certain further declines, have a notably poor track record as forward indicators. In June 2022, when sentiment was at comparably dire levels, Bitcoin was within weeks of its cycle bottom at $15,500. In March 2020, extreme fear coincided almost exactly with the COVID crash low before a massive rally. BlackRock's $213 billion IBIT outflow matters less than the fact that 94% of ETF Bitcoin holdings remained, despite maximum fear. That's institutional conviction, not abandonment. Before I give you the three scenarios, let me be completely clear. Nothing in this video is financial advice. I am not a licensed financial advisor. Considering that Bitcoin has just suffered through its fifth consecutive month of losses, a streak not seen since 2018, with the asset shedding nearly 15% in February, this is not a comfortable market to be in. The bear case is real. 62% of polymarket users think Bitcoin goes below $50,000. Standard Chartered cut its year-end forecast from $150,000 to $100,000, warning Bitcoin could hit $50,000 near term before recovering. For March specifically, the range of outcomes is bracketed by $60,000 on the downside and $72,000, $75,000 on the upside. The key $60,000 support level is being closely watched, with a break potentially opening the way to the mid to low $50,000 range. That is a real risk. Manage your money accordingly. Never invest more than you can afford to lose. Consult a licensed professional. Now, the three scenarios. Scenario 1. Hayes' thesis plays out and the Iran war triggers Fed easing within 60 to 90 days. This is the bull case. Henrik Zeberg wrote in his March 2026 portfolio outlook, Bitcoin rallies to 110 to 120K in the primary scenario, fueled by risk-on fever, ETF inflows, and continued institutional adoption. He also outlined a secondary scenario with a 25% probability where Bitcoin could climb to $140,000 or $150,000 if the cycle extends further. For this to play out, the sequence needs to be war escalates or extends, U.S. spending increases dramatically, Fed signals concern about economic impact, FOMC on March 17th or May meeting delivers a cut or dovish pivot, ETF flows turn positive and sustained, Bitcoin breaks above 70,000, then 72,000, then tests the overhead resistance at 76,000. This scenario is not the immediate outcome. It is the multi-week to multi-month outcome if Hayes is right about the 40-year pattern. Scenario 2. Bitcoin consolidates in the 64 to 68,000 range while waiting for clarity. The miner selling exhaustion, long-term holder selling collapse, and ETF outflow reduction all point to a market that is mechanically stabilizing. Bitcoin's path to a market bottom could come as soon as next month, according to Ronnie Suster, head of research at Mercado Bitcoin. Applying the same 12 to 13-month bear market pattern would place a potential bottom around February 2026, with a recovery possibly beginning in March. In this scenario, Bitcoin builds a base between $64,000 and $68,000. The 68,200-week EMA acts as the ceiling until the macro catalyst arrives. Patience. Dollar cost averaging at these levels. No leverage, no chasing. Suster calls for investors to build their positions intelligently and leverage a dollar cost averaging strategy to take advantage of current market fear. Historically, buying during periods of fear has been more effective than buying during euphoria, he wrote. Scenario 3. The war escalates beyond the current strikes and creates a genuine global risk-off crisis. Oil supply disruption, Strait of Hormuz threat, broader regional conflict. In this scenario, Bitcoin's correlation to risk assets pulls it lower despite all the structural bottom signals. Standard Chartered has cut its year-end forecast to $100,000, warning of a near-term slide to $50,000 first. With Trump's new global tariffs adding pressure to equities and potential U.S.-Iran military escalation weighing on risk appetite, Bitcoin's risk-on behavior keeps it vulnerable. In this scenario, 60,000 remains the last structural defense. Below 60,000, the mid to low 50s become technically accessible. Know your plan before this happens. Decide in advance what you do at 60,000, at 58,000, at 55,000. because when price is moving through those levels, you will not make a rational decision without a pre-established framework. Here's the complete picture as of March 2nd, 2026. Bitcoin trading near $66,000, 47% below its all-time high. 5 consecutive monthly losses. Fear and greed at extreme fear. ETF outflows collapsing 94% from November peak to February. Long-term holder selling down 87% in 4 weeks. Minor capitulation selling down from negative 4,700 Bitcoin per day to negative 837. Strategy just bought 3,015 Bitcoin for $204 million, their 101st purchase in a row, holding 720,737 coins at a $7 to $9 billion unrealized loss without blinking. Arthur Hayes publishing a 4-decade historically documented thesis connecting every U.S. Middle East war to Fed easing to Bitcoin appreciation. The FOMC meeting 16 days away on March 17th and 18th. CoinCodex forecasting Bitcoin to reach $72 to $290 by March 6th. 62% of Polymarket users pricing in a sub 50,000 Bitcoin at some point this year. This is the most conflicted, most data-rich, most historically significant market setup Bitcoin has faced since November 2022, when it was at $15,500 and the FTX collapse had just shattered the market entirely. And yet from that $15,500 bottom, Bitcoin went to $126,000. Not because the news was good, not because sentiment was positive, because the structural forces that create recoveries, selling exhaustion, institutional accumulation, monetary policy shift, were quietly assembling themselves in the background while everyone was declaring the bull market permanently dead. I am not telling you that history will repeat exactly. I am telling you that the 3 structural forces that have preceded Bitcoin recoveries in every previous cycle, selling exhaustion, institutional accumulation, and monetary policy shift, are all simultaneously in motion right now. The selling is exhausting, strategy is accumulating, and Hayes has documented 40 years of evidence that the monetary policy shift follows the war. The question is not whether these forces exist. They clearly do. The question is timing, and timing is the thing nobody can tell you with certainty. Hayes wrote, "The prudent action is to wait and see. The time to back up the truck and buy Bitcoin and high-quality altcoins is immediately after the Fed cuts rates and or prints money to support the government's goals in Iran. That is the most honest and most actionable piece of guidance available in this market right now. Not a price prediction, not a guaranteed outcome, a framework. Identify the trigger, wait for the trigger, act on the triggers to watch in order of importance." 1. The March 17th FOMC statement, specifically whether the Fed's language acknowledges that the Iran war creates economic uncertainty that could require policy response. The specific phrase from the 1990 Gulf War FOMC minutes, "Events in the Middle East had greatly complicated the formulation of an effective monetary policy," is the language pattern to listen for. 2. ETF flow data daily on SOSO value, watching for the 94% outflow collapse to turn into a flow reversal. 3. Bitcoin's ability to hold $64,000 as structural support through the geopolitical noise. 4. Minor hash rate recovery, which would confirm the hash ribbon buy signal that has been approaching confirmation for weeks. And 5. Above $70,000, momentum could shift quickly given how much short positioning has built up during the correction. Drop a comment right now. I want to know one specific thing. Before this video, did you know that every U.S. war since 1985 was followed by Federal Reserve easing? And does that historical pattern change how you're thinking about Bitcoin right now? I read every comment, and the conversation here is always the most honest, real-time sentiment gauge I have. Subscribe if this gave you something real, a verified, historically documented framework for understanding Bitcoin's most complex market moment in years. This is what this channel does every single time a setup like this develops. See you in the next one.